But what was really interesting to me was a few of the other markets. Oil rose 9.5%, almost 10% on the week. And I was talking on this podcast about how cheap oil was and how I didn't expect it to stay cheap. And I pointed out in terms of gold, it was basically a record low. And so oil prices ended up about $74.50. They closed last week about $68. So I think we've broken out of that downtrend. I mean, part of that had to do with hostilities with Israel and Iran and the potential for an escalation there. That may have just been the catalyst to break the downtrend. But now that that little trend is broken, to me, it looks like oil prices are headed higher from here, not lower. And again, that is symptomatic of inflation, because the big driver for the drop in headline CPI was the big drop in oil prices. And as I've said, as that reverses, those numbers are going to feed in to that headline number. But again, the Fed's kind of on autopilot. But what's happening in oil is indication that the Fed was wrong. I mean, why did they do 50 basis point cut? Why did they cut at all? Oil prices are rising. Hey, the job market, according to what the government says in Wall Street, job market is strong. Unemployment is falling. Jobs are being created. There were some other numbers that came out this week in the service sector that were stronger than expected. All the manufacturing numbers were weak. In fact, I have some of those. The factory orders were minus 0.2 in August. They were supposed to rise by 0.2. So that was a weak number. What else we got? I had a bunch of these weak numbers. Construction spending was down again, 0.1. It was down 0.5 in the prior month, even with the reduction in mortgage rates. We still saw that. PMI manufacturing numbers for September, 47.3. Below the 47.9 from the prior month, a little bit above estimates, but still down. It's anything below 50 is contraction. I mean, this manufacturing recession has been weak. The ISM manufacturing number for September, 47.2. That was below the 47.6 estimate, same low number that we got in August, 47.2. So all of these manufacturing numbers, Dallas Fed manufacturing -9 was -9.7 the prior month. Production index, which was plus 1.6, sank to -3.2. So no one really cares. I mean, Joe Biden or that Kamala, is bragging about all the manufacturing jobs, and now Kamala Harris wants to take credit for this manufacturing renaissance that doesn't exist. Even the government-owned numbers show that we're in a manufacturing recession. Chicago PMI, another September number, 46.6, a horrible number. Yeah, it was slightly less horrible than the 46.1 that we got the prior month, but it's still way below 50. But the only number that really came out strong was the ISM service index, and that actually gave a boost to the dollar, came in at 54.9. Well above the 51.5 for the prior month. So that was a lone kind of outlier. But again, if the service sector, because then that's 70% of the economy, right? Manufacturing, unfortunately, is a tiny slice of this economy. That's part of the problem. The much larger slice is services. And there we saw the big jump. So all that would suggest that the Fed's rate cut was a mistake. But nobody cares that it was a mistake. Everybody is just glad that the Fed is cutting rates. But not only did we see the move in the oil market, look at the bond market. And this is a move that I had predicted. In fact, last week, I said that I thought that in this quarter, before the end of the year, the yield on the 10-year would be back above 4%. And we're almost there. We're at 3.97. We were like 3.7 a week ago. So 3.97, we should be well over 4%. Headed up to 4.5, shortly, probably before the end of the year. I don't know that the Fed will let us get back to 5%. I thought that rising long-term bond yields would ultimately be the catalyst for the return to QE, and I still stand by that call. The yield on the 30-year U.S. Treasury is now at 4.25%. And, we've got the yield curve steepening now. On the 2-year, you're at, Well, the 5-year is 3.8. So you're going 3.8 to 3.97 to 4.25. You still have a little bit of an inversion because the 3-month is 4.61. That's still the high end of the curve. And the 6-month is 4.44. But I know that the long end is going to get back above the short end. And again, it may even do it this year. We get another rate cut this year and long-term rates continue to rise. That's going to normalize the curve. But again, the longer-term rates, that's what has more of an impact on the consumer. That's what's going to determine mortgage rates. That's what's going to determine other borrowing costs that directly affect the consumer. And these rates are going in the wrong direction. And the only way the Fed is going to bring them down, at least temporarily, is by a return to quantitative easing. But before they can return to quantitative easing, they got to stop doing quantitative tightening, which they are continuing to do. In fact, the balance sheet is getting very close now to $7 trillion. It's not below it yet, but it's as low as it's been since they started shrinking it. Now, the dollar index had a big move on the week. It was up about 2 full percent. That's the strongest week I've seen. The dollar gained again today on the jobs numbers. It gained on that ISM number. It's been strengthening all week, particularly against the Japanese yen, but also against the euro, the Swiss franc. The dollar index closed the week at 102.5. You know, we were very close to breaking 100. We were about at 100.2 earlier in the week. And we had this rally in the dollar index. Now, I don't think that the rally is going to last. I think that it's going to roll over and head back down. But that was more significant move. And what that is basically suggesting is now the way the currency trader is looking at it, they don't expect the Fed to be as aggressive with its rate cuts. That's probably what currency traders are betting based on these numbers. I think that they're wrong. The Fed is still going to cut rates. But what's important is that real rates are going to fall regardless of what the Fed does, because inflation is going to be on the rise and the Fed is going to completely ignore it.